What we're going to do is we're going to pick up where we left off in the last class on the PVH model, and we're going to finish the valuation of PVH, which will involve creating 4 files, as is target, bull, and bear. So our next step, now that we've finished most of the model, is we've gotten to an $83.50 stock price. At the time of the video, their stock price was $143.68, so we're just going to kind of continue along with that process. And the key here is we're going to do the first of the 4 Excel models called the as-is. So as part of the as-is valuation, what we want to do is, it's not whether we agree with the stock price or not, but we're trying to mathematically represent what are the key variables that get us to that stock price. All right? And so what we've done so far in the model, going back to the assumptions, is using a WACC of 8.7%, using a G right now is at 3%, shares outstanding of 76.9, and basically these 3 years of forecasted sales of sales and EBITDA, which gave us that EBITDA margin, and changing the ratios here to match for the first 3 years the revenue growth rate and the EBITDA margin of the EEO. We were at 83.50, and we need to get to 143.68. Right, and I'm just going to say that our range of tolerance, call it plus or minus $1. Got to be within $1, so just pretty close to the current share price, because obviously it's going to bounce around a trading range throughout a day. Right, but nonetheless, the key is what assumptions, given the academic formulas, had to have been made to get to that share price. So what we're down to is basically we need to flesh out what the EBITDA margin will be longer term and in perpetuity, what we think the growth rate is going to be, and we think a more realistic G. Now, coming up soon, we're going to talk about multiples. And there's a chapter in the book on multiples. There's a PowerPoint lecture we're going to do on multiples. But I'm going to just pull some of that material forward, which we'll cover in more detail later, to help us as we finish up the process. Because multiples, actually, trading multiples, give us information about a company that will help us answer some of the questions that we need. Okay, so pulling forward into an upcoming lecture note that you don't have yet, this is one of the slides which starts out with key value drivers and rearranges the math, just algebra, and you actually get to an enterprise value to EBIT multiple. Okay, so this is actually the formula for estimating enterprise value to EBIT. Okay, then what we're going to show you is this is the formula and the derivation, taking the key value driver formula, rearranging the math algebraically to get to enterprise value to revenue or enterprise value to sales multiple. Okay, so multiples are more related than you think to cash flow, and we're going to show you the direct relationship. And more specifically, what are the drivers of multiples are the key value drivers. And particularly 3 key multiples: EV to sales or revenue, EV to EBIT, EBITDA close to that, and basically the PE ratios, but the key value driver ratios. So here's the thing. I'm going to start out with this final one. So this is EV to sales. This is the formula. So what we've done is we've taken no plat and we've broken out into pre-tax margin, which is EBIT, times 1 minus the tax rate. Okay, and that's mainly what's going to be key to driving the enterprise value to revenue formula. Now, here's what's interesting. In the EV to EBIT derivation, we basically went from this to this, which is 1 minus the tax rate times 1 minus the growth over ROIC divided by WACC minus G. So again, EBIT and tax rate are broken out rather than just having one no plat. So if you actually look at this EV to EBIT in the EV to sales formula, that's this. So EV to sales or EV to revenue equals margin times EV to EBIT. So if we do one more piece of algebra, estimated perpetuity margin of a company equals enterprise value to revenue divided by enterprise value to EBIT, right? And so what I'm telling you is hidden in plain sight is the long-term operating margin, EBIT margin of a company. Okay. Now, the key to multiples is we care more about the future, so it's about forward multiples. And what the book will tell you is that we're more normalized on what's called FY2. Okay, so just going back to PVH, what do you think is FY2? Is it 18, 19, or 20? Today. Which one's FY2?
20.
19. Okay. Yeah, 2 out of 3 guesses. But here's the point. So 2018, even though they're going to report in a week and a half, is still not reported. So it's still an unreported current year. That's called FY1. All right. So the next full year, which doesn't include any of the current year data, is called FY2. So FY1, FY2, FY3. So basically what we're going to use is forward year 2 as the normalized numbers for multiples. So here's what we're going to add to our model, starting in row 15. So I need to know the forward year 2 EV to sales or revenue. Now, Bloomberg, and this is off the EEO screen, actually has it right here. They call it EV to revenue, forward year 1, forward year 2. So for them, it will be 2019. In a week and a half, it's actually going to be 2020 once they actually report their 2018 results. But for now, this is still forward year 2. So EV to revenue, and so I'll put in revenue here just to match. Okay, and I need it for 2019, and I also need forward year 2. Put 2 in there. FY2 EV to EBIT is the other number that I need. So for 2019, instead of using today, because the stock price is a little different than what it was on Monday when we first started working the model, I took a screenshot of where we were in the video on Monday. And on Monday, going back to our screenshot, here, EV to revenue was 1.50. Okay, so let me go back here, and this was 1.50. So what that basically meant is PVH is trading at 1.5 times 2-year sales. That was their enterprise value on Monday. All right, EV to EBIT at the time of the valuation, right here, 14.76. Times 2019 EBIT. That's what they were trading at the time of Monday's stock price. So, estimated EBIT margin equals enterprise value to sales divided by enterprise value to EBIT. It's basically 10.2%. So, since this is key value drivers, we're talking perpetuity equations. For continuing value, the market is using approximately a 10.2% operating margin to value PVH based on its Monday stock price. That's the margin they have to use to make the math work. Okay, so obviously there could be some slight variations in their models, but somewhere around 10.2 is what the analysts have to be using on a cash flow basis to value this company at this discount rate. Yes?
What's that figure? How did you get the 10.2?
Take EV to revenue divided by EV to EBIT.
Okay.
So these two I should make yellow, because for any company, including your L Brands assignment, you're going to do the same thing. All right? Matter of fact, one of the things we'll do when we do multiples is we'll actually be able to pull an industry margin, and we can actually see what the industry margin is, what the company's expected margins are, and that's not historical, that's forward. So based on trading multiples, we can actually get an estimate of what people's margins are expected to be. Now, this is into perpetuity. It's not 1 year. This is long term, but nonetheless, how would this affect our model? Well, I go back to our ratios. We know that the analysts think that the 18, 19, and 20 margins are going to go from 13 to 13.7 to 13.9 in EBITDA. Which of these numbers is this? 10.2. On the ratios, which of these rows does the 10.2 correspond to? What do you think? 10.2. EBIT margin. Which one of these is EBIT margin in our model?
Operating.
It's the operating income. And so basically, it's the perpetuity value that we're really talking about. So in this case, it's M8. But that cell's not yellow. That cell's white. So that means I shouldn't change it. So how do I make this 10.2 if I can't change it?
You have to change the inputs.
Either change depreciation, change EBITDA. All right, since depreciation isn't going to change too much, we're assuming productivity stays the same, we're going to change the EBITDA. So instead of 13.9, 14.1. So what we've done is we have used the trading multiples to get us a more realistic, or at least to get an understanding of what the market must be using to forecast EBITDA margin long term. And so the market's using 14.1 into perpetuity. Now it's interesting that in the next 3 years, the analyst consensus thinks they're going to go from 13 to 13.7 to 13.9 and eventually settle out at 14.1. So we're not that far from 2020 to 2023. By the way, that's an $86 share price, up from 80, was it 83.50 or 82.50? So that extra little bit of margin doesn't really change their stock price a lot. All right, so that hints that what do you think is going to have the biggest impact at closing this gap? Yeah.
Wait, where did 14.1 come?
14.1 is what we had to make the EBITDA margin to get this to be 10.2. So that was 13.9. I changed it to 14.1. And then we had to figure out how to get from this to that. So at some point they go from 13.9 to 14.1. If I just wanted to go gradually, I could put in gradual over 2 years. And what you're going to see is that really doesn't change the share price all that much, right? Because it's relatively close to the current margin. It could be dramatic for other companies. So the point is, whether you made this 13.9, 13.9, 14.1, or this 13.9, 14.1, 14.1, or 13.9, 14, 14.1, you got to get to 14.1. Okay, so since it's not that big a difference, I'm just going to step it up a little bit, 13.9, 14, 14.1. Okay, questions about what I just did? Okay, so basically what it says is growth is what's going to matter. All right, PVH is all about growth more than it is about increasing their margins. That's what's going to close the gap, that final $60 that we have to find. So next, we got two growths. We got these growths for these 3 years, and we got to figure out a G, a more realistic G. Okay, so here's the other thing. Let's go back to the multiples. So in the upcoming lecture on multiples in the book, this is the formula for EV to EBIT, forward EV to EBIT. So we know our EV to EBIT multiple based on the market today. Tax rate, we already estimated a tax rate. WACC, we estimated a WACC. And ROIC, we've estimated an ROIC for the firm. So you know what we haven't estimated? A G. So we can actually solve for a G that basically gets us to this EV to EBIT, assuming our other multiples assumptions come true. So what I'm saying is, by using the academic formula here, we can kind of get a baseline estimate for G rather than just taking a swag, because this would be the G that would explain the multiple. Does that make sense? So let's go back. What do we need? So in our model, we need, this is the number that we observe in the real world, and this is the model. I'll put it here. This is the model this is going to be our model EV to EBIT. We'll put it right there, right next to it, right? That we're basically going to solve for. Now, what do I need? I need a G. I need an ROIC. I need a WACC. And so the one thing I'm missing is a tax rate, which I've done on the other page, but just so it's all on this one page, and I'll make this yellow, equals, from the ratios, the tax rate. Now, somebody in the last class mentioned we could have used the perpetuity tax rate number, meaning we could have used the column M, but since we're not really changing the tax rate year by year, I'm just going to be lazy and use the first year. But the point is, you need the representative long-term tax rate. And I'm just putting it here so that all the numbers are on one page. Percentage, 2 decimal places. Okay, so let's solve for EV to EBIT given the data that we have. So here's the formula. So EV to EBIT equals, left paren, 1 minus the tax rate, right, times left paren, 1 minus the growth, divided by the ROIC. Take all of that and divide by the WACC minus the G. So basically 10.35. So at a 3% G, given those assumptions, that would be a 10.35 EV to EBIT, but we're observing 14.76. So do you think the G is going to be higher or lower than 3%? Well, let's see. Let's make it 2%. Oh, wrong one. Let's make it 2%. Nope. Not lower. 3, 4, 5, 6, 7, 6.7, 6.8, 6.78, so a little under 6.8%, 6.77% is the G that explains the EV to EBIT in the marketplace today. Yes?
Show the formula for the EV.
This formula is basically just the one from the book for EV to EBIT, the rearranged key value driver formula, plugged into the model. Now, if anybody who's fancy math major wants to give us a derivation to solve directly for G, have at it, but this one I'm just iterating. Keep it simple. Okay, questions? All right, so here's the point. What's share price now? With 6.77, what's the share price? We're now at 129 share. Okay, so what does that leave us with? These three growth rates. The market must believe that the growth rate for 21, 22, and 23 is higher than 4.8%. So let's start plugging the last part of the model. What if this were 6%? 6.5. 6.2. I think 6.2 will do it. Plus or minus a little bit across these 3 years. But here's the point. The market must believe somewhere around 6% growth gets me to a 144 share price. Given and a long-term G closer to 7%. So in a way, you can argue that the as-is, the market's relatively bullish on PVH's future. Right? Because despite all the disruption, all the other changes, they're giving them credit for a lot of growth at this improved margin to basically justify the price at the time of the valuation at 144. Questions? File, save as. This is the video, as is. So we have just completed the as-is valuation. And so here's what we know. That basically, that given that the analysts are expecting an approximately 16.75% tax rate, somewhere between 16.5% and 17%, right? That's the guidance of the company, right? Given that based on the next 3 years of growth and the improvement in margins that are based on the current analyst consensus, right? We estimated using the current EV to EBIT multiple a 6.77% growth G, and given that, we estimated about a 6% growth rate that got us to match the current share price. That's our process. Okay. Now, to be honest with you, this number now slightly changes because of the change in the growth rate, and we would iterate again, but I think this is close enough for what we need to do. Okay. So if you can at least match the G and then match the growth rate, that's sufficient for what we're trying to do today as the as is. All right. But here's the point, because every time you change the model, everything's going to update. So very complex multi-factor model. But the point of the story I want to make is that somewhere around 6% is the growth rate the market's looking for over the next 5 or 6 years per year. Somewhere around a 14% EBITDA margin, up from last year's 13.5% EBITDA margin, and somewhere around a pretty long-term G, or almost 7%, is what the market's expecting of PVH to justify cash flow-wise the current share price. Now, what's important about everything that I just said is it's not whether I agree or disagree with this. It's what it is. Like, to justify the price, this is what the math has to be. Okay? And that's what we're trying to do. We're trying to back out some starting assumptions. We're not putting our opinion in here yet. We're basically trying to just use the academic stuff we know and market-based data to tease out what has to be in people's cash flow models to get an intrinsic value close to the stock price. That's called the as-is. That's your first step. Again, questions about anything that we just did? Okay, so next we have to do 3 more models. The bull, the bear, and the target. Right? Now in the last class, I actually started with the target, but for this class, I'm going to actually start with the bull and the bear. Okay? You can kind of go either way, but here's the point. When we get to the target is your opinion. The target is where you put in what you think it actually should be, right? But before I give you where I think it should be in the target, we want to establish the bull and the bear, which means we want to establish the range, okay? So here's the thing. What's really going to change in this model is our assumptions for growth, our assumptions for G, our assumptions for EBITDA, and our assumptions for tax rate. Those are going to be the primary things that we have to change and explain. And we have to come up with reasonable parts to this. So again, I'm talking to an investor. Right? They're trying to understand PVH, who's had a pretty good run up in their share price this year. And so they want to know not just what do I think about what the stock price is going to be, but they want to understand the risk. So how high could this go? How low could this go in the next 12 months? What kind of delta could I see in the stock price? Okay, so that's what we're trying to get to in the bull and the bear. So let me give you my bull scenario, and this is what you're going to have to do for L Brands and subsequently other companies. Right? So going back to the assignment we did where we looked at PVH and its industry in the first week of class, which was the group project assignment, we should know a little bit about the company and some of the keys to the bull and the bear. So let me give you my bull scenario. Number 1, PVH is successful in getting Calvin Klein in Europe to become as strong as Tommy Hilfiger in Europe. Right? They hired their brand ambassador, the Kardashians. Right? Gigi Hadid as the Tommy brand ambassador maintains 2 strong brands. And so Europe is a big source of growth and profit for them. In addition, as part of the bull scenario, that now that they control the license to China in a very rapidly expanding marketplace in China, PVH will be successful in penetrating China and going from a few $100 million in sales to a much bigger number over the near term. That is why we're actually expecting the growth rate of PVH to accelerate. Right? In addition, I think the margin expansion will come as PVH focuses more on Tommy and Calvin, less on legacy brands. The license for Mr. Klein is expiring, which will help 1% of margin. The license for Tommy Hilfiger, they pay him a license as well, is eventually going to expire, which will help their longer term margin. And that is why we think that the margin expansion will hold in these rapidly growing markets. So I actually think that PVH's revenue could actually be a little bit better, and instead of falling to 5%, I think it could be 6%, and then as high as 7% in 2021 and 22. And I think that this margin might even go higher to 14.5, and that gets me, and I think the tax rate is probably not going to get lower, right? Even though we have a 21% tax rate in the U.S., tax rate in most of Europe is around 20, China is around 20, but even with tax benefits and savings, I don't see it's going too much higher, but it's probably not going to go too much lower, so I'm going to leave the tax rate the same, and I'm going to leave the WACC the same, so that gets me to a stock price of about 175, right? So I think in the next 12 months, if things really go right for PVH, their share price could get as high as 175 for the reasons that I stated. File, save as, full. I've given you the top of my range. Right? I'm not saying it couldn't possibly go higher, but reasonably based on real world expectations, not just wild ass guesses. Like, this is somewhat fact based on what we've read and understood about the industry and some of the key catalysts that would say how PVH has a reasonable story to get an extra couple percent growth and higher than what the market's thinking. And, oh, by the way, on the assumptions, I think the G could then go closer to 7%, which, by the way, puts them at 189 a share. So I'm going to save that as part of my bull. So I think that if all continue well, and we're going to find out in the next 12 months that there's just so much expansion opportunity in Asia, the focus on controlling their brands, that the other key assumption here is that disruption in North America does not hurt them as much as people expect. That it kind of levels out because people will still buy from the Macy's, and that online does not really hurt them as well. Could potentially help them. Then that just gives them a growth platform globally. And now that they're focused on Asia, to some degree Latin America, I think that they can get as high as 189 a share. That's my bull scenario. Right? Now, file, save as, bear. I haven't changed anything yet. I'm about to. So now, and I want to state that when I was in college for 4 years as an undergrad, I used to do what's called APTA, the American Parliamentary Debate Association. In fact, one of the people I debated against pretty consistently was a guy named Ted Cruz, if you know him. He was actually an APTA debater. He's 2 years younger than me. He went to Princeton. All right, but long story short, the cool thing about parliamentary debate, which is why I did it, which is unlike what they used to call NDT, which is National Debate Topic, where you had one topic that everybody did research on, parliamentary debate was literally, you didn't know what you were going to say until you started, and then 8 minutes later, after the pro side said whatever they said, the other side had to argue against it, no matter what it was. And they would throw real moral things at you. So for example, one of the debate cases we had was, you're Truman, it's World War II, don't drop the second bomb on Nagasaki, right? So basically, you just dropped one on Hiroshima, don't drop Nagasaki. And no matter what your moral scruples are, you had to basically, on the op side, argue for dropping the second bomb, right? And so basically, I only say this because over 4 years, people like Ted Cruz got really good at explaining a point, whether they believed in it or not, right? And what I'm telling you is that's a skill set we got to practice here as an analyst, because your bull scenario is one scenario, and I have to give a bear scenario at the same time, which could actually be different than my bull scenario. And I got to put my pessimist hat on now, and I got to say, okay, what could really go wrong here with PVH? Okay, and I got to put a very pessimistic hat on. So let's talk about what could go wrong in PVH. Number one, PVH Calvin does not get to be as big in Europe as Tommy was. As a matter of fact, Tommy has a brand problem because Tommy's entire brand is the American flag. And right now, the perception outside the U.S. for the next few years is very negative about the U.S. And getting people to buy clothing wrapped up in the American brand could be a challenge for a company like Tommy Hilfiger. By the way, we're now picking a trade war fight with China and Europe, two critical markets to PVH. And Europe has already said that their retaliation is against American brands, including Levi's and Harley Davidson and Jack Daniels. And easily, PVH could get caught up in this. And that could tamper growth in the next few years in the markets that they are really primed to do well in. In addition, as I look around this room, I think the age cutoff for millennials is 1985. I think I was reading about that somewhere. Okay, so that pretty much covers everybody in this room, and that's a key segment of their growth as they go after the young. And I know that this is a sample size of about 30 people, but what I see in the millennials, and as I look around the room, I don't see a lot of branded clothes. Is anybody wearing a Michael Kors? Is anybody wearing a Calvin Klein? Is anybody wearing Tommy, Chanel? Anything? High-end? High-end brands? In the room right now? You got one person with one jacket?
Oh, I got
Okay.
some Calvin Klein.
On? You got some Calvin Klein socks?
I got a Tommy shirt.
You got a Tommy shirt? One out of 30?
Thank you, Dan.
And here's the thing. I see a lot of athleisure in the room. And what I've noticed about students is if we were going out for a beer on Friday night, assuming it was legal drinking age, I don't think you're going to be dressed all that differently than you are now. Is that I think the millennial generation, so this here's a key part, fast fashion. I think fast fashion is a real problem for branded companies like PVH because particularly the young, they don't care about spending a lot of money for brands. They want value. They don't necessarily need the label. And companies like Zara, H&M, and Uniqlo in Asia have tapped into that market. Companies like Adidas and Nike and Under Armour are much more of a challenge in the athleisure wear rather than formal, more expensive branded wear. And I'm not saying that people won't buy it, but that could tamper growth. And the growth rates may not be as strong and could put a challenge on the margins associated with PVH. So, given that, I think that the G could be closer to 5%. Given that, I think that the growth rates could be closer to 5%, not 7%. So I'm not saying the growth won't be strong, it just may not be as strong and materialize as fast and as enduring as we think. And I don't think that the margins are going to improve. As a matter of fact, what if the margins got a little tougher and they were closer to the margins we see today at 13.5%? Because in order to compete in that more competitive industry, they can't get the price premiums. Matter of fact, the other challenge I potentially see for PVH is the rise of e-commerce. And they have said that Amazon is one of their launch partners. Amazon's not about raising the price of a brand. Amazon's about lowering the price of the brand and getting mass market volume appeal. That could be a further challenge on their margins as they partner with Amazon for the online stores, and further disruption of retail could also crimp North American growth. So if they don't get a rise in margin and if the growth is a little bit more tepid, I'm still saying at 5%, so I'm not putting it off the table. It's an $86 share price. That is my bear. And by the way, that's a pretty big range. Yes, sir.
So, I see. We got your. I got it.
That's my bear.
Yeah, I was looking at your.
So what I've really told you as an investor is two scenarios that got me my bull and my bear. But what I've also communicated to you is there's a lot of risk in PVH's stock price. Like this isn't a very predictable stock where you're just going to have plus or minus 10% delta. Like you could actually see a gigantic swing in their stock price. And oh, by the way, here, so I'm outside of the bull and the bear, but here is PVH's stock price for the last 5 years. It was 130, fell to 70, rose to 143, today is at 142. Now, here's what's interesting. I had an email from one of my TAs, and he said, one of the students said that PVH's performance has actually been great as part of your previous assignment that he was grading. And I said, well, no. Stock price has done really well in the last 12 months, but it's done pretty poorly over the last 5 years. Right? So just to put that into perspective, if I were to take, and this was actually the chart that you saw in the group assignment, but if I go to the chart content, actions, compare. So I want to compare to the S&P 500 index. and normalize this, that's the S&P 500 during the same period of time. That's PVH. So what they're really doing is they're kind of catching up to the market, but they've underperformed the market consistently over time. And I can go to comp, another screen in Bloomberg. This is 5-year total shareholder return through today. PVH has averaged 3% a year over the 5-year period with reinvested dividends. The average S&P 500 stock is 14. The average retail stock is 17. So what I'm telling you is PVH has a history of volatility. And by the way, you know what drives the volatility? Is it margin? Growth. The difference between 5% growth and 7% growth is about $60 to $80 a stock price. Right? And that is what's critical to understand about PVH, is everything is going to be dependent on the growth of PVH. Right? And so even in the conference call, it's going to happen in a week and a half. Analysts are going to be looking through the tea leaves, and they're going to be doing the exact same thing. They're going to try to figure out, all right, what does everything we hear mean to growth rate? So I will bet there will be questions about the trade war impact and how that will affect them. There will be questions about what's going on in Asia. There will be questions about Amazon and online things from the analysts, because analysts know that their entire recommendation is going to hinge on how fast they grow. And I'm not even talking about not growing. I'm not putting the growth rate at 0 or negative. We're still growing at 5% in a tough retail environment, and that's an $80 stock price. 7% is a $180 stock price. So I got a $100 swing based on 2% compound annual growth, right? So it's just how fast and how much is that growth going to be, plus or minus a little bit of margin. So that's what they're going to be poking and prodding on, and that's what I need my investor to understand, is that slight changes in growth have big impacts on PVH's stock price. So I'm going to give you a recommendation for where I think it's going to be, but you still got to understand that you're taking a lot of risk in this stock. Now, there could also be a lot of reward in this stock. So for example, if I'm sitting here on Stock Track and I'm thinking about a company that could actually be a big winner or a big loser, here you go. This is a company kind of a big delta coming out of their earnings call if the market has slight changes in what they think is going to happen to the value of their company based on the growth rates. So, long story short, I've established my boundaries, and more importantly, I gave you rationale for why I changed what I did. So again, in the context of G, in the context of growth, in the context of EBITDA margin, in the context of tax rate, I explained my as is, I explained my bull, and I explained my bear. That is part of your upcoming homework assignment. And by the way, something you're going to do for every company throughout the rest of the semester is that what's important is not just the numbers. It's why are you changing the numbers? And that's the point. You can't just say, I'm going to make it 3%. Why'd you make it 3%? Because 3% seem right? Like, that doesn't mean anything. And that's what I'm also saying. You got to make it somewhat fact-based. Like, I'm tying it back to realistic facts that we read about. And we can have a difference of opinion because nobody can predict the future. But nonetheless, I got to give you at least what I think could happen in retail as catalysts that could cause changes to the numbers. That's what's key to your next assignment and to some degree your group projects. Questions? Yes, sir.
So it's up to your discretion to determine, in terms of like being fact-based. So it's up to your discretion saying, all right, it's going to be 5 and not 4, or.
Well, that's what I'm saying. Your discretion as the analyst. You as the analyst have to determine, is the bear 3? Is the bear 4? Is the bear 5? I know right now it's harder because you don't have enough context in the industry, but what you're going to find through repetition and experience is that your feel for what these numbers are will be better. But that's the other point. The nice thing about this class, it's real world. Read the analyst reports, right? Don't plagiarize. You can reference, but hey, I read the analyst report and I actually agree with the JP Morgan analyst for PVH and he said the growth was going to be this. Or I agree with the Goldman and she said this was going to be this. So the point is you can actually reference an analyst if you wanted to for your bull and your bear, right? Because there's some that are bulls, there's some that are bears. Or, use other data. But that's the point. You got to at least make it somewhat fact-based. You can't just take complete swags on this stuff. Right? Other questions? All right, now we get to the fun part. And to me, this is the fun part. Because now it's all the qualitative side. What's the target? Where are they going to end up in this range? So before I give my answer, anybody want to tell me Which story do you think is more believable? Do you think my bear story is more believable or my bull story? Yeah.
Fair.
Why?
I mean, there's more material problems facing the firm right now that you can kind of point to and say like, oh well, the odds of that resolving are fairly low, and whereas like the opportunities are actually kind of offset by recent developments, like we talked about the tariff, but just like there's more problems than opportunities in my opinion.
Okay, so just can you list a couple of the problems that are concerning you that you don't think will get resolved?
Yeah, I don't think that first of all, I think our assumption that they're the 1% going off to Tommy or Calvin, I think that's probably kind of immaterial to the margins, and then sentiment towards U.S. goods, like you mentioned with the Tommy Hilfiger, it's not that hasn't been. I mean, I feel like the sentiment towards U.S. goods is like generally turning. People are kind of fed up with the United States right now, mostly because of, and this is the next point, kind of terrible international trade policies that we've been putting in place. So that those are kind of the two major factors I think that would probably drive.
So where do you think
growth?
we're in that growth continuum? Do you think it's 5? Do you think it's lower than 5? Like, what's your gut feel tell you?
I mean, I don't know much about the industry, but I'd say like on the low end, like 5.
So even if we go to 5, which is still good growth because
Yeah.
U.S. GDP is growing too, so they're still growing 2.5
I mean,
times
there's strong
GDP.
brands, but the kind of the external factors facing them are robust.
Okay, so if we're down to 5, and now you said you don't think the margins are going to be helped, but if they're not hurt, so let's just put back to the margins of where they think they're going to be in 2 years. So they don't get the extra 1%, but they don't lose what they have. Sorry, terrible keyboard here. Sorry, equals. If they get 5% growth, but they maintain their margin, they're at a $90 share price. So you're in the sell category. Okay? And I can't say that you're wrong because, as I said, I don't know what the future is going to be beholden, but at least based on your experience as an analyst and what you said, I can evaluate it as an investor 2 ways. One, I don't just evaluate that you said sell, but I can actually start to think about, all right, do I believe his assumptions? Does it ring true to me? Right? Because that's how I'm going to eventually evaluate you. That's why it's important to explain your assumptions, not just give the numbers. Right? Anybody else agree, disagree? And there's no right answer here. Anybody on the bull side? Anybody think that's closer to the bull scenario? Yeah. Or in the middle? Or where?
I think the bull scenario just completely ignores like a huge thing that's going on right now in the
Which is what?
market, which is the potential trade war and very that's.
So you're on the bear side then?
Yeah, I'm on the bear side. I just
Interesting.
think that the bull scenario just ignores like a pretty significant, turn of events that's going on right now. And even I think that's a pretty big assumption just to ignore.
Well, again, as I said, I think we have to understand what could that impact be. Could it impact a company like a PVH? And what could that impact be to PVH? So I think that's a legitimate cloud that's going to hang over them and other companies, branded companies, particularly have a lot of international sales. By the way, what we didn't talk about is impact on currencies, because trade wars could also affect currencies, and currencies could affect sales and margin as well. So what happens to the dollar in this trade war? Do people start abandoning the dollar and the dollar plunges? And then what could that be? Or maybe not. Maybe they run to the dollar and they run from these other countries. We don't know. Like as I said, these are other impacts that could affect a global brand. But regardless, I'll give you the sentiment today. Sentiment today are 14 buys, 3 holds, and no sells. Now, here's the thing. These are the target stock prices that were updated. Now, this is pre-trade war announcements. But 176, 155. The lowest target stock price by the analyst today appears to be 135, Morningstar. Okay? But the analysts in general, you average these, 12-month target price, 160. So at least as of February, most of the analysts were on the bull side. Right? And that's the point. It's basically they're saying, hey, we think we need a lot of growth, margin expansion, everything will be great, all these things will go well. And I don't know if the analysts are going to turn, but if we know the analysts turn, we know how low the stock can go. Right? And so that's the point. I think, I'm sending a pessimistic scenario. Maybe I'm being too pessimistic. But that's the point. At some point, I got to put a stake in the ground and give my opinion. And to be honest with you, if I had to put mine out there, this is what I did in the 11 o'clock class, I'm on the bear side. I think their stock price is going to be probably closer to 80 or 90. I don't think it's going to stay at 140 for the reasons that we just talked about. And again, it doesn't take much of a decline in compound annual growth. We're talking about going from 7% growth to 5% growth is going to kill their stock price. And I really worry for the reasons that you just said about PVH in the short term. And I think that hasn't been priced into their stock yet. But again, I think a lot of this is going to come out in a week and a half. Because on that earnings call, the analysts are going to be trying to read the same tea leaves we're talking about, and they're going to listen for any kind of signal that comes from their CEO and CFO about what they're saying and their impacts on the business, what's going on in China, what's going on in Europe. Are they meeting it? Is it taking longer to ramp up? Are some of these issues that we were talking about resolved or unresolved? And that's what's going to really drive their stock price. Right? So again, if I did my last one, I'd probably put assumptions closer to 5%. I'd probably keep, to be honest with you, something closer to this and file, save as, target. And I would call this my my target, which is a sell. So plus or minus 10% is a hold. Right now, given all this uncertainty, I would put them in the don't buy list. What would Kramer say? Ring the register. Take the gains. Lock them in. All right, too much downside risk, not enough upside in the short term. Questions? All right, you're going to repeat the same process with the same 4 files for L brands. Okay, Victoria's Secret, and was it Bath and Body Works, and what's the other pink brands they have? Those? Pink. They're like 4 brands, but it's primarily Victoria's Secret. So here's the thing. To be really clear, you might want to redo your homework assignment just to make sure you didn't screw it up. Or because remember the data changed. Some of you actually had data through 2017. They're now 2018. So basically for L brands, what you should have done, and again it wouldn't hurt to quickly do this again, is if you go to FA and if you go to custom, go to your model template that you created. Now, if you're comfortable that you did this with the 2018 data, you're probably okay. But here's the one danger. If they've updated anything in the last week since that press release, then Bloomberg will put the updates in real time. So I always like to do it again. It can't hurt. It's an extra 2 seconds. So basically, here's the data through 2018 that was released. Export, Excel, current template. Then, very important, we can't have dashes. So copy the dashes, find the dashes, replace the dashes with zeros, replace all. So that is the most recent L brands data from Bloomberg as of today. Okay, so then what do we do? Well, what I would say is you now have 4 files from PVH that we just created in class. You can pick any one of them. So what I'm going to do is I'm going to pick the as is, but I can take any one of the 4. It doesn't really matter. Okay, but this is our reusable model. Here's how we reuse it. So you go to model data, and I take my L brands data that I just exported, and basically what I do is I select the whole tab. Okay, and then I right-click, copy that whole tab's worth of data from the file I just exported, or from your homework. Then window, go back to the model, and then I come in here to PVH, model data tab, select the whole tab, right-click, and instead of pasting, don't paste, paste special, right? Because if you paste, it'll make references to that other model. And every time you open the spreadsheet, it'll say, where's this LB data file? Okay, and it'll just cause you angst. So what you want to paste special values, which means just paste the numbers. Hit OK. So when you copy across spreadsheets, paste special values, just the numbers. Now, row by row, everything's been updated for L brands. Right? Then what do? We go to assumptions. Oh, L brands, they've already reported their fiscal 2018 as of February 3rd. So my last reported year, 2018. Don't forget to change that. So you're forecasting through 2024 for L brands, their fiscal 24, right? Which is really 2023, but it's their fiscal 24. So change last reported year. Then their WAC. I will need L brands WAC, right? I will need their current share price and their shares outstanding, 282.3 million. So I'm going to have to estimate a G. I'm going to have to change the shares outstanding, because if I hit PVH shares outstanding, it's going to cause problems. Their share price right now is 43. So I'm trying to match a completely different share price. Put that in here. From the EEO, I need to update that data. From the multiples on the EEO, I need to update that data. Okay? Then on my ratios, and this is actually the other thing I would say is very important. These numbers were kind of hard-coded because I changed them based on PVH. So make sure you don't have lingering PVH assumptions in your model. This is why I told you it's important to highlight in yellow what you changed and change it in a few places, because when you reuse it, like for example, their tax rate is probably not, when we do the search, it's probably not going to be 17%. It's probably going to be higher because they do more sales in the U.S. So long story short, when we figure out what their tax rate is, if we don't change it, we have the PVH tax rate, that's going to be a problem. So one of the things I like to do is just equal the previous year. Same thing with EBITDA. Equal the previous year. Copy it over so that my hard-coded assumptions that were in there, and same thing for growth rates, aren't lingering around, because it can really frustrate me when I'm making changes if, like this final year, which was hard-coded, was a different margin. Now, it's not dramatically different for Victoria's Secret, but if it were, that could really cause problems in my valuation, right? But nonetheless, I get my model ready to go. Now, obviously, I didn't put in all the data because you got to do this yourself, but nonetheless, you need to be within $1 for the as-is. Then, create your bull, create your bear, create your target, write a minimum of 500 words. You might say, gee, what am I writing 500 words on? 500 words on explaining those 4 variables. How'd you get your G? How'd you get your tax rate? How'd you get your growth rate? How'd you get your EBITDA margin? That's in the as-is. Then, why'd you change it? When I did the bull, why did I change it? What were some of the assumptions that led me to change my growth rate? What were some of the assumptions that led me to change my EBITDA margin? What were some of the assumptions that led me to change anything else? Same thing. When I switched to the bear, what was my assumptions for why I made the bear changes? And then target, this is why I made the assumptions that led me to be where I think I'm going to be on that range. That's what the paper's about. Also, upload your 3 screenshots, because as you can see with share prices, even today, L Brand stock price is down $1.53, right? I don't know what's going to be tomorrow. I don't know what's going to be Thursday or Friday. It could change. And so basically, it's going to be as of the time of the valuation. So you need to upload your screenshots for 2 reasons. One, so the TAs can see that this was the multiples and this was the price on the valuation time, because you're not all going to do it the same day. And number 2, to make sure that you didn't collaborate. Okay? Sharing of screenshots is not allowed. You must individually take your screenshots. Sharing of Excel files is not allowed. You must individually create this model, right? Because if you don't do it yourself and somebody else does it for you, you'll have no idea why any of this stuff works. So you got to get your own screenshots. You got to get your own data. It shouldn't take you long. Matter of fact, here's the thing. Right now, you get about 10 more minutes before this class technically ends. We're about to end. You can get the data right now in class from Bloomberg. Okay? You can re-export the data in Excel. You can take the 3 screenshots, put them on a thumb drive, email it to yourself, and you got the models, which you can then work on outside of class. You don't have to come back and go back to Bloomberg, and you can do the valuation as of right now. So that's one of the other things that I'll mention for you. But you're going to submit 8 files as part of homework 4 by 10 a.m. Eastern Standard Time on Monday. The 4 Excel files, the as-is Excel for L Brands, You're not submitting anything on PVH. I call this the great bait and switch because you thought you were going to submit your PVH files. You create the PVH files so you can do the L brands valuation. So basically, as is, bull, bear, target, that's 4 files. 3 screenshots, DES, WAC, EEO, which you'll need the data for anyways, and Word or PDF write-up explaining your changes and assumptions across the 4 models. Okay. By the way, it's probably one of the bigger assignments we're doing, but to me, this is kind of the interesting stuff. This is a snapshot of what you're going to be doing for your group projects. Okay. Except instead of a few days, you'll have a month to work on this. But this is what's going to be upcoming right after spring break. Right. But in terms of the model's almost done. We're going to make a couple minor tweaks, but other than that, this is a real model. It will work. And now, as I said, comes the hard part, or the fun part in my mind, which is not the math. It's actually the assumptions. All right, questions? Yes?
So what sort of stuff can we rate for the as is? Full bear and target?
As is pretty much, I got the tax rate from the earnings call. I got the G based on these multiples. So less so about the as is, that's more technical. What's going to make more sense is the other 3. But we need you to put at least what the assumptions are, because if the TAs are grading it, what they need to know is why did you change it? Because the answer might be, and we did a PVH, we left the tax rate the same in all 4. So that needs to be a red thread that goes through all 4 of my write-ups. Hey, for the bull, I don't think the tax rate's really going to change. For the bear, I don't think the tax rate's going to change. For my target, I don't think the tax rate's going to change. It could be the same thing. Margin. I don't think the margin's going to change, right? But I think the growth is going to change, or the growth is going to not change, and the margin's going to change. And again, that's what you got to figure out. Last but not least, BICO. You probably don't know a lot about Victoria's Secret, and I'm not asking you to do a huge amount of research, so take advantage of what's here. BICO. Company, industry. All the basically cliff notes of all the analysts are put right here for you. Okay, so again, a lot of issues face them that face PVH, but you can see it right here. And here's the nice thing about BICO. Again, if you don't want to come back to the lab, actions for the company BICO, export to PDF. Industry BICO, actions, export to PDF. So you can actually take the PDFs of the BICO with you. So again, you don't have to make trips back to the lab. Okay. Now I'll make one quick comment about BICO, and we probably need help more from the women in this class than the men in terms of their target demographic. But what's some of the challenges that Victoria's Secret is facing right now? Because they're actually facing some real challenges the analysts are worried about. What's happening to them at a company or industry level? The men are like, I don't know. Come on, women. What are some of the things that either you personally experience or you're hearing about with Victoria's Secret, or you've not heard anything about it, or you don't shop there? Anybody have any thoughts? What does Victoria's Secret primarily sell? Undergarments, lingerie. Okay. What's some of the challenges they're having in the lingerie market right now? All right, I'll help you. Sports bras. Women are increasingly buying sports bras, not traditional Victoria's Secret like lingerie bras. And so basically the rise of athleisure is also changing how people are buying their undergarments. And that is affecting Victoria's Secret and the way that they're selling. So that's one of the challenges they have. So it's companies like Nike, it's companies like Adidas, it's companies like Under Armour, but increasingly it's other companies that are selling undergarments that are now much more competitive. And to some degree, the analysts are worried that Victoria's Secret is missing a trend, and that could be pressure on growth and competition in the marketplace. So you'll read about this in the BICO, okay? But nonetheless, that's actually one of the challenges for growth of Victoria's Secret is basically consumer preferences are changing, and the stuff that they're selling is not aligning with what the future is going to be and is much aligned more with what the past was. And so what does that mean for a company like Victoria's Secret going forward? Right? Matter of fact, their bra line last year was actually a little bit of a flop because people are buying less uncomfortable bras and more comfortable bras. I'll keep it, politically correct. But the point is, that's also a trend that's affecting somebody like a Victoria's Secret. So again, when you get into this, you want to again read through what some of the challenges are. The other problem is they got a bunch of retail stores, and right now people moved online. How does that impact them? Okay, and what does that mean in terms of their business going forward? So, long story short, you want to kind of understand some of the issues. BICO will help. Right? This is just a preview of what you're going to be talking about. All right, any last questions? All right, I'm going to stop the video. Otherwise, we'll see everybody and we'll discuss L brands on Monday.